Jon Williams here with Manulife Securities and Williams Financial Group, and today I have with me Duncan Anderson, a Senior Portfolio Manager with Manulife Security Asset Management. And today is our first interview that we're calling the Masters of the Market. Duncan's team at Manulife manages over $12 billion, of which we use multiple mandates with our client portfolios. And today it's early 2014. I just want to recap last year with Duncan as to some of the things that we saw happen in the markets and also where some of the opportunities are for 2014. Just to start off with, last year it seemed like it certainly paid to be invested outside Canada, both from a currency perspective as well as a market perspective. What were some of the big winners last year that you guys saw?
Well, all markets actually performed very well outside of Canada last year. The Canadian market had a good return in the low teens, but obviously the US market was very strong. And it was very broad-based across all of the US market. And if you're outside Canada, you wanted to be certainly unhedged as the US dollar appreciated against the Canadian dollar. But it wasn't all bad in Canada. There were some very, very good performing securities. If you were outside of the energy materials sector, there were a lot of Canadian stocks that in fact did quite well. Some of them were names like Gildan, Constellation Software, Saputo, WestJet. There was a lot of Canadian companies that in fact did very well that just weren't large representations within the TSX.
Oh, I see. And so the Canadian portfolios that you guys run, how would they differ then, I guess, compared to the Canadian index?
They differ in a significant way. In fact, on our Canadian portfolios, about 95% of the portfolio is different than the TSX. So we have portfolios that don't own any banks or insurance companies, that own no gold stocks, no material stocks, and in fact have a very small weighting to energy, with one name being Imperial Oil.
So if I take a look at the Canadian stock market and I exclude my resources, materials, banks, and insurance companies, who do I have left?
There's in fact, a lot of great Canadian companies. They just are smaller in market cap, so therefore they're not a large representation within the index. So if you can create a portfolio to get exposure to those companies without regard for a market cap weighting bias, then you can create a portfolio that has great companies. They just tend to be...
Canada has some of the best banks in the world globally, according to many different sources. Yet it doesn't sound like you have any Canadian banks or other banks in your portfolios. Why would that be?
It's all due to the structure of a bank. The asset side of the balance sheets may be very different, i.e. in the US they had a lot of subprime mortgages. In Europe they owned a lot of sovereign debt. In Canada our banks have a lot of mortgages that are insured by the Canadian government. So the assets of a bank can be very different. However, the structure of a bank is the same regardless of country. So banks typically need a lot of leverage in order to generate a good return for equity holders. And so when we're creating our portfolios that are between 20 and 30 stocks, in all businesses that are doing very different things, we want to make sure that we don't have a lot of financial leverage, that if we hit a credit crisis, our portfolio will be impacted significantly. And that's why we prefer not to own banks in our portfolio.
And without getting too technical, I've heard you talk about before the difference between return on equity and return on assets. And that's the sort of return on asset part that takes out the leverage on the balance sheet, essentially?
Yeah, exactly. A return on assets would be the return that the business can generate before any funding sources are taken into consideration. So if a business was fully funded with equity, so shareholders' money, then the return on assets would equal the return on equity. But as soon as you start to add any liabilities, it can be interest-bearing debt or it could be bank deposits. As soon as you start to add any liabilities into the equation, you can actually amplify the return to equity holders because they actually put in less money, and so they get an amplified return.
Okay. So looking forward into 2014, as you've mentioned, the markets sort of worldwide have had a pretty nice run. Whenever that happens, people do get nervous. They wonder, are things getting overvalued? Are you still finding opportunities out there in the marketplace? Or are you guys starting to sort of pull back on the sidelines a little bit?
No, we're definitely still finding opportunities in the marketplace. Maybe the best example of this would be we run a balance fund, and the alternatives right now are between cash, fixed income, and equities. And our balance fund is currently constructed with about 85% in equities because we see that as the best opportunity in the marketplace right now, given the returns that cash is offering and given the returns that fixed income is offering. We'd rather be owners of these great businesses that can compound for us as opposed to being lenders in the fixed income market and getting 3.5%.
Speaking of fixed income, I know you run mainly equities, but you mentioned that in your balanced portfolio. What is your perspective on bonds? I certainly personally am fairly nervous of owning long bonds in any of my clients' portfolios at this time period. What's your thoughts on bonds these days?
Yeah, we would agree with that, and that's obviously what's reflected in that balance fund mandate is of that 15% that we have allocated to cash and bonds, the bulk of it right now is in cash. So we want to be on the short end of the curve because we believe we're not being compensated to go out long on the curve, and we're also not being compensated to take on some of the credit risk that's longer out on the curve. So we would agree with you that the long end of the bond market is probably the more risky end of the bond market right now, and it's probably the bond market that's going to drive the Fed to raise rates.
Right. Now, when let's look forward and hopefully we have some continued great markets. It seems like the Fed is continuing to slow down their stimulus programs. What happens to stocks when those programs eventually stop and they actually perhaps start to slowly raise interest rates in that scenario?
Well, it's very hard to know what happens to stocks in the future, but the math of it is such that although they're slowing down, interest rates are still very low, and so if the Fed is tapering, it's a sign that they believe the economy is strengthening and the economy is in fact getting better. And some of the stats that we're seeing out of the U.S. would suggest that. We're seeing home prices now starting to increase again. We've seen a very strong stock market. So we're seeing asset prices reflate again in the U.S., which is a good thing. So if the economy continues to strengthen, then you want to be an owner of companies that are going to benefit from that. But on the other side of that, eventually people will make a decision to get back into fixed income when those rates of return are higher and compensate them for the risks more appropriately.
Right. So in your balanced portfolio, it sounds like you're still finding opportunities, things that you're excited about. Is there one or two different areas in the market or companies that you're particularly excited about that, or are there any themes that you still see that there's very good value in from maybe a sector or a theme, or is it really you just, or any companies in particular that you're excited about that you can share with us?
Yeah, let's just maybe bring it up to the portfolio level, like sure. how excited we are about the portfolio that we've created of 25 different businesses, but each business doing something unique and all very interesting businesses in their own right. But we've been able to create a portfolio that has virtually no debt, is doing almost 30% return to the equity holders, and we're paying about 14 times multiple for that business. So the way that we think about our portfolios is more of a company. Our company that we've created with these 25 stocks, all doing very different things, is a very high return business without financial leverage that we think is attractively valued. And for us, we want to be owners of that as opposed to lenders in the bond market because we believe that that's the best risk-reward opportunity.
And when you use a number like 30% return on equity and the PE was around 14, what does that mean to the investor? What does that mean? What's the impact of that to your portfolio, the business that you own? If I have 30% ROE, what's that mean? Where's the company growing next year? What's the impact of that?
Yeah, so the return on equity would simply mean the returns that the business is generating for the amount of money that the equity holders have put into it. And you increase the likelihood or the odds of success if you can get higher profitability. You increase the odds that the future prices will be higher in the market. You increase the probabilities that you will do well if you buy cheap companies. So when we can combine high return with good valuation, it's multiplying the effect that the probability of success is much higher for our portfolio.
That's great. Well, Duncan, I'd like to thank you very much for your time today and for coming in and sharing some of your ideas with our clients. And thanks very much again for coming.
Thank you.